You only go to jail if you're literally defrauding your investors. If you are running a Ponzi scheme or you're commingling and using funds from one to another or using it to buy your yacht, then okay, we're talking Bernie Madoff style.
Welcome to our Hero Capital Raising show. We have a very special show today, back-to-back show between Mauricio and myself. I was just on his syndication live just a few minutes ago, and here we are on our capital raising party here. So yeah, super excited. Mauricio, can you hear me?
I can hear you. Can you hear me okay?
Perfect. Yep. And hold on real quick. We're going to spotlight you. There we go. All right. Yeah. So I was just on Mauricio's show to talk about AI tools, which was a fun topic. And now we're going to a more serious topic on funds, how fund managers, the top 5 things they must know to stay out of jail, which is a much more serious topic. But I am definitely super excited. And one of the reasons why this topic came up, because Mauricio recently released, and Mauricio, if you can share your video on the chat as well, of the one that you did on the case, I don't know if you call it case law, but the situation with one of the operators that the SEC found to be guilty of practicing broker-dealer without licensing, right? Capital raising without license. And so that's what prompted this show. And for those of you who don't know Mauricio, top SEC attorney in our industry, probably one of the most popular and maybe the most handsome as well. So with that, welcome.
It's good to be here, Tim. This is fun going from my event, Real Estate Syndicate Live, to your event, the capital raising party. So this should be fun.
Yes, definitely. Yeah, let's jump right into it. Share with us a little bit about you and your area of expertise, and then we can jump into the topic at hand.
Yeah, so I'm an attorney. I've been doing this for 25 years, since 1999. So literally October, it'll be my 25th year of practicing. Spent all of that time doing some form of securities laws. Right now, 100% of our practice is real estate syndications, real estate funds, real estate fund of funds, anything related to real estate capital raising. That's what our firm does. It does the compliance work on it. I started my career at a litigation firm. So I was involved defending some of these big companies, JP Morgan's, Merrill Lynch, American Express. Whenever they got sued, they'd call us. I would be doing the motions and the courts and depositions and the appeals and kind of the litigation piece. But I left that after about 6 or 7 years, went to work for the real estate guys of all folks. They were doing a ton of syndications back in the day. This is 2005. And that's really where I cut my teeth on the actual syndication part. And then I left the guys, kept them as a client, and started Premier Law Group in 06. Had Premier Law Group now for almost 20 years, I guess 18 years. And it's evolved over the years. But as of today, we focus exclusively on real estate syndications and real estate funds. We don't do any other kind of syndications. We don't do venture capital. It was great to see, your good friend, Bridget Pennington at your event last year. And he was talking about all the other capital raising stuff. And like, no, we don't do any of that. We only do real estate funds, real estate syndications. And we're going to talk a little bit about the difference, because I think that's one of the big mistakes people make. And I think it's an important thing, that one of the 5 things. And by the way, I wrote, just to give it context too, I know the title is an interesting one. It plays off a book that I wrote called The 5 Things Every Syndicator Must Know to Stay Out of Jail. And I'm not going to get into those. That was more broad. If you want to get a copy, stayoutofjail.com, you can get it. But that's where I go into some of the more...
I love the domain name.
You can get the book for free. You just go grab it. But today we're going to really focus on specifically for fund of funds. So I'm not going to talk about 506B, 506C. I'm not going to talk about pre-existing relationships or advertising rules or whatever, unless you guys have questions about it, obviously. But I figured I came up with these 5 things that I think every fund of fund manager, and the first one I think is probably one of the most critical ones that most will miss unless you've been coming to Tim's events or you've heard me speak before. But that is, once you start doing fund of funds, and by fund of funds, what we mean is simply that you're raising money into your fund to then go invest into somebody else's fund or somebody else's syndication, right? You're not buying real estate. You're actually going and investing in somebody else's fund. That's why we call it a fund of funds. Sometimes they're called feeder funds. Sometimes we use the term SPVs, which I don't like, but we'll talk about that in a second. But that's what a fund of funds is. And a very critical distinction happens at that point. And that is, you move away from being a fund manager that invests in real estate, literally a real estate fund. That's when you raise a bunch of money into a fund and you go acquire a piece of property, whether it's multifamily, self-storage, whatever. That's a real estate fund. When you do a fund of funds, you're now investing in a security. You're basically investing in shares of somebody else's company, that other company being the underlying syndication LLC. You become a limited partner in that deal. You become a shareholder, right? You're buying shares of that company. And so you're no longer buying real estate, but you're buying securities. And that's a really important distinction because it changes the whole game, right? We no longer can just worry about, do I do 506B? Do I 506C? You know, what's my exemption? That kind of stuff, which is what I usually talk about. Now I move into a much more complicated world where, because I'm in the business of buying securities, there's a bunch of other regulations that we need to start worrying about. And so that's something that you really understand, because you can't just go into a fund of funds situation and be like, I'm just going to do a 506B or a 506C, and then that's it. Like, I've got to worry about so much more. So it tends to be a little bit more complicated, but that's probably the number one thing I would want to point out. The other thing I want to point out, and I'm starting to develop this line of thinking so I can help folks clarify. As you, Tim, I'm known as one of the few attorneys that actually speaks English. So I'm always trying to, how do I make this into sort of more bite-sized, understandable things? But there's this term being used around a lot of SPV, right? Which is really just either a single purpose vehicle or a special purpose vehicle, however you want to call it. And that is to distinguish it from what I would call a true fund of funds. To me, when we're talking about fund of funds, when I use that term, we're talking about me putting together a fund where I then go out and look for other syndicators, other syndications to invest in, almost like a mutual fund, right? So I raise money to my fund, and then I use my expertise, my relationships with people to invest a couple bucks here in Tim Mai's fund, a couple in Lenny's fund, a couple in Mauricio's fund. I go out and I look for operators who have their own syndications, and I go vet those deals. I do my due diligence. I do my underwriting. I do all that work that you're doing. That's what I really call a fund of funds. And I distinguish that from what people call SPV, which is, I don't like that term anymore, which is really more of what I would call a feeder fund. And what a feeder fund is, same concept. You're raising money and you're buying shares in somebody else's company, but it's a one-to-one deal, meaning I'm raising money into my fund for the specific intent of investing in that particular deal. If Tim Mai has got a fund, I'm going to go raise a bunch of money to invest specifically into Tim Mai's fund. And in fact, I'm telling my investors, hey, I'm raising $1 million into my fund, and I'm going to turn around and I'm going to put that $1 million into Tim Mai's fund. And in exchange for that, I'm going to own 10% or 1% or whatever percentage of the fund. And that is an important distinction that I wanted to make. And I wasn't quite sure if that was number two. I think it's just part of number one, but it does make a difference. And I'll tell you why in a second. Let's talk about number two then. The second thing you need to understand as fund managers is, once you understand that you're raising money for an underlying fund, meaning you're buying securities, then the first regulatory thing I got to worry about, the next regulation, in addition to Reg D and 506B, 506C, is what we call the Investment Advisory Act. Because what the SEC looks at you as the fund manager is, oh, wait a minute, you are a fund manager and you are advising your fund as to the purchase of securities. Not advising as to the purchase of real estate, which we don't need a license for, but as to the license of securities. And this is where it gets interesting, because there's a lot of different opinions out there. And I'm here to give you all three levels of opinions out there. And then I'll tell you where I fit in, although I think I've been pretty public of where I fit in. But I tend to view this scenario as like, am I an investment advisor? That's really the question that we're trying to figure out when we're talking about fund of funds, because that's a very important question to answer. Because if I am an investment advisor and I have to register somewhere, that becomes problematic, because I may have to think about a bunch of other regulations. But on the other hand, if I'm not an investment advisor, then I don't have to worry about all that regulation. So it's a really important question is, am I an investment advisor? And if so, do I need to register somewhere? And when it comes to these SPVs, these feeder funds, there's really three positions to take. And I'm just going to go really simple. I'm going to do it, in my opinion, there's the aggressive method, the aggressive approach, the really conservative approach, and then there's this approach in the middle, right? And so there's the aggressive approach that says, hey, you're not an investment advisor at all when you're doing a one-to-one SPV, because you're not even advising your investors as to you're literally telling them, here's the investment. You go make the decision whether to invest in this one deal or not. So I'm not even advising you. I'm just here managing the stuff. That's a view that I've seen quite a bit out there these days. And I consider that a little bit of the more aggressive. I'll tell you why in a second. The opposite side of that is not only are you an investment advisor, but you have to worry or look at the states, not only where you're located and making the advising, but you have to look at the state of every single LP in your fund. So if you have an investor in your fund from California, I got to worry about California law. If you have an LP investor in Chicago, I got to worry about Illinois laws. If I have somebody in Florida, I've got to worry. So now suddenly I have to at least pay attention to possibly 5 or 6, almost like the blue sky filings, right? I got to worry about all these states where my investors are located. That's the more conservative. And then there's the sort of the middle ground, which is actually where I fit in, which is, that's ridiculous to think about every single investor. But you do have to worry about the state where you are doing business, meaning where are you advising your fund? If you happen to be in Texas, if it's Tim doing it, I'm going to say, where does Tim advise his fund as to the purchase of securities? He's in Houston, Texas. So I got to look at Texas law to make sure I don't have to do anything there. The good news is most states have an exemption. So it's not like I've got to go register or do anything crazy. It just means I have to look at the state and say, okay, what are the exemptions in that state? And what are the things that I need to make sure my fund complies with in order to do that? I don't think you have to look at every single investor or every single state where you have investors in your fund, because it's very clear. We'll get a little geeky here, but according to the SEC, your client, the way it looks at your client, is the fund. The fund itself is your client, right? That's the investor that you are advising. You're advising your fund as to the purchase of securities. You're not advising your LPs as to the credit. You're advising your fund. And so to me, it's like, where is the fund located? Where are you located? Ideally, they're in the same place. That's one of the things I would recommend you doing, even if I wouldn't be in Texas and try and setting up maybe a Wyoming fund or something, because then you may have to worry about 2 different states. Just make them in the same state. That way you only worry about that. And I don't think that you can, I don't know where the argument is, honestly, where the argument that you're not advising your fund. Advising, according to the SEC, is very broad. There's a bunch of examples of what constitutes advising, and it includes reporting. Like you could just be, once you're reporting to your fund, and that constitutes advising. You're obviously at some point going to make an advice as to when to sell the stuff or whether you should do a cash call. There's all kinds of decisions you need to make. So anyway, we don't need to get into that thing, but that's a very important point, is you need to understand and you need to be comfortable with your securities attorney as to, am I an investment advisor? I say yes. And then do I need to register anywhere? And in most states, I would say 45, I know at least 3 of them. So let's go 45 to 47 of the states have some form of exemption. It just means how onerous is that exemption. Some exemptions are super easy. And they're like, look, as long as you have less than 15 of these fund to funds, we don't care. Right. And you don't hold yourself out as an investment. We're good. Other states, Texas is a good example. There's a lot of folks, a lot of clients of mine are in Texas. Texas said, we don't care. You don't need to register as an investment advisor, but you have to limit your investors into your fund to accredited investors only. So as long as you limit your credit to only, and you don't hold yourself out as an investment advisor, you're good. They actually want you to file some form, but whatever, that's good. Then you move into other states that are really a pain in the ass, like Hawaii, for example. They don't even have an exemption. So if you live in Hawaii and you're advising your fund and you decide, yes, I have to comply with Hawaii law, there is no exemption in Hawaii. So you would have to register as an investment advisor in Hawaii, which, by the way, is not the end of the world. I'm not saying, oh my God, this is now, it's just, hey, you got to go take an exam. You got to do this. It's not the end of the world, but that's something you want to keep in mind. If you look at a lot of the funds, I actually was thinking about, you had Bridger, Tim, on your event last year, and he's such an eloquent, such a great, he's really a kid. He's really a young guy, but he's such a wealth of information. He has a really great video on his YouTube channel, which is, I think is like how to structure your fund or something like that. And he talks about how most funds are structured where you have a GP, like a fund manager, right? And you have a registered investment advisor separately, because that's the investment advisor that's actually doing the advising. And so that's usually a separate entity or separate person. And that person is usually a registered investment advisor. Now, Bridger deals with big numbers. And so a lot of times you have to register when you have big numbers, but when you have small funds like us and we're raising $1 million or $2 million or $5 million, I still believe you have to have a separate investment advisory, but it doesn't, you usually will not have to register. You'll have an exemption to registration. But I'm thinking about doing sort of a Mauricio reacts to that video because I think he's got a lot of teachable things in that video. But just know that when you're talking about private equity, which is what you are now, you've moved away from being a real estate fund. Now you're a private equity fund because you're investing in companies, you're investing in shares. Then usually the structure involves both a GP and an investment advisor. And the question just becomes, do you need to register somewhere or not? That's my third, I think, or second. I've lost track now of what that was, 2 or 3. But
real quick, so I can
remind
remind everyone, as Mauricio is going through, if you have questions, go ahead and put in the chat. After he's done, we are going to be open up for Q&A here. And so do make notes so that way he can expand on any of the stuff that he's talking about for you.
Yeah, I'd love to answer questions. I know this gets a little bit in the weeds when it comes to the legal stuff. Again, I don't think you guys need to understand the specifics of the law. It's just like 506B, 506C. You don't, even though a lot of you guys know the differences, at the end of the day, you just need to understand that you need to find an exemption. And you got to pick one. You got to find one. Is it 506B, 506C, Reg A, Reg CF, Reg this, Reg, whatever it is. You just need to be aware that's out there. Then you can have a conversation with your attorney. What's best for my specific situation? That's all I'm really advocating here is, hey, when you do fund of funds, or what again, fund of funds is pretty clear. I think these are all the feeder funds or these SPVs. Just make sure what questions to ask the attorney and make sure you're getting some advice specific to your situation. Because again, depending on where you are and how complex it is, it'll go different ways. The other thing you have to understand too, in addition to the investment advisory rules, you now become an investment company because you're basically just investing in another company. So now you are, and again, because you're investing in securities, we have to worry about this Investment Companies Act. And the last thing you want to be is an investment company because that opens up a bazillion. So you really need to find an exemption in this Investment Companies Act. Now, the good news is there's a relatively easy one that actually a lot of you guys probably have heard about it, except you just didn't know that it was investment companies that would apply to this one. But anytime you hear that rule that, hey, I'm limited to 99 investors, and if you guys have heard that limitation sometimes, I get that a lot in syndications too. Hey, I heard I can only take 99 investors. When you're doing a syndication, a real estate syndication, that doesn't apply. This only applies when you're investing in securities, not in real estate. But one of the exemptions to the Investment Companies Act is if you have less than, it's really 100 members in your LLC, but because you count as a member, you're down to 99. But honestly, if you have co-sponsors and you have 5 co-sponsors, then you're down to 95. So as a whole, we want to keep it less than 100 investors. And if you can do that, you're going to be eligible for something called a 3C1 exemption. That's the exemption you want to get. And so hopefully you're not going to go over 100. If you do go over 100, I would say you're in the 10%, like 90% of people won't go over. So if you're in that 10%, there are other strategies that we can come up with to get around the Investment Companies Act because you do not want to be categorized as an investment company. And then the last thing that I want to talk about, which is the fifth thing you want to understand, and this is where the case that came in, and I didn't look at it before, so I already forgot the name of the guy, but this is interesting to me because I want to say it vindicates me a little bit, but I've been arguing for the last couple of years that in addition to all the other things you have to worry about the broker-dealer laws, because you don't want to be in a position where it looks like you're just raising money for the underlying operator, right? Because if that's the case, then we all know you can't get compensated to raise money for others unless you have a broker-dealer license. And so I've been harping on this idea of at least looking at it. Again, all I want people to do is look at it. I'm not saying you are a broker. I'm not saying you don't have a way around it. I'm just saying you have to look at that analysis. And some of the pushback I've gotten is, no, it doesn't really apply in this case because you've got your own syndication, you're doing your own PPM, you're doing all this stuff. I don't have to worry about the broker-dealer laws. There was a case that just happened, I think it was May of this year, and I apologize, I should have the name of it. I didn't have it in front of me. But essentially, the SEC came after a gentleman who had put together a fund of funds. It was really a feeder fund because he was raising money. He raised, I think, $2.8 million into his fund. He then took those proceeds and invested it into, I think, numerous funds, but they were all the same operator. So it was like one operator had a bunch of different deals. And so he invested in that company's deals. He made some silly mistakes that are easily avoidable. He took a transaction-based compensation, which is something I've always talked about to everyone. Is you never want to take an acquisition fee or any fee based on how much money you raise. You never want to base your acquisition fee on the amount raised. And that's what he did. I think he would write a $500,000 check. He would take 8% of that and take it off the top before giving the 500 grand to the operator. So he was clearly taking transaction-based compensation, which, as we all know, is the hallmark of broker-dealer activity. But that's just a pro tip in general. If you're doing regular syndications, never take an acquisition fee based on the amount of money raised. Always take on the purchase price of the property or the acquisition cost, or just some, or maybe just, hey, I'm taking 50 grand or 70 grand or just some number. Never tie it to, if I raise 2.1 million, I'll get 210 grand. If I raise 2.5 million, I get 250 grand. So you don't want to do that. But this guy put together his fund of funds, and the SEC came after him for basically being an unlicensed broker. That basically all he was doing was taking money from his investors, giving it to these underlying folks, and this whole structure in between the SPVs and the LLCs, it didn't matter. At the end of the day, the SEC looked straight through that and said, look, are you raising money, on behalf of some other operators? Now, again, I think this particular case was very specific to this guy. I think his name is Lewis, now that I'm thinking about it. Very specific to this guy. But it goes to show that the SEC is looking at that. Like, you have to at least address the potential issue that, are you acting as a broker-dealer? And you want to make sure you're taking steps to ensure that you're not. And I've talked about this in the past, but you want to be able to start adding value to your investors so that you can argue, or it's true, that you're not getting paid to raise money for the underlying operator. You're getting paid for something else. So, for example, what does that look like? I just saw, I don't know if he's on this call, but I saw Scott here, one of our clients on the prior call. He's doing a fund of funds, and he's doing an SPV, a feeder fund. But he got on a plane, flew down to the property, and did his own due diligence on the property. I don't know if he walked all the units, but he basically walked the property, did his due diligence. He did his individual due diligence. He trusted but verified the information he got from the underlying sponsor, gave him the underwriting. The underlying sponsor told him the plan. He had already vetted the sponsor. He'd done his due diligence on the sponsor. He'd met with the sponsor. Now there's a unique investment. He took the underwriting. He did his work. He got on a plane. He flew down to the ass. So he's adding all this tremendous value to his investors, because his investors don't have time to go do all the stuff he did. They don't have time and probably don't know how to underwrite a property, or when you go down to the property to see what the stuff is. So that's what he's getting paid for. He's getting paid for doing all that work on behalf of the investor. The other thing that would be amazing is sometimes, and this is really what feeder funds are really meant to do, is that the minimums may be too high. Now, in the larger world, funds are sometimes have $1 million minimums or $5 million. Sometimes you raise a $100 million fund, the minimum may be $5 million. Like, most people don't have $5 million to invest, or may not want to put in $5 million. And so these feeder funds are created to basically allow them to invest into those funds at a lower minimum, and then they can aggregate everything and go in as the investment. So that's something that if you could offer, that would be great. Maybe the minimum investment in the fund you're investing in is 100 grand, but your minimum is 25 or 50. So it allows people to come in that otherwise wouldn't be able to go in. You're adding a ton of value. Negotiating better terms is another big one. And I know that's built into a lot of these models now, because that's a great way to show that you're not a broker, which is, hey, I'm coming in with $1 million investment or $500,000 investment. I have the power of the group behind me. I'm going to negotiate better terms for my investors. So instead of getting 70% of the profits, a 70-30 split, I negotiate an 80-20 split. So I get 80% of the profits. Or maybe I negotiate a better preferred return, or maybe I negotiate being a seat at the table of the advisory board, so I can then represent my investors at the board. So again, you're just adding value to investors. And if you can show that, hey, if you had invested directly with the fund, you would have gotten this return, but because I negotiated better terms, you got slightly better terms. Again, you're adding value to your investors separate and apart from just the capital raising part, because that's what you're really looking after. You're trying to show, I'm not acting as a broker. I'm actually adding value to my investors. I'm getting paid not to raise money for underlying folks. I'm getting paid to do the due diligence, to do the underwriting, to vet the sponsors, to negotiate better terms, to do this, to do that. And the longer that list is, the better. So anyway, I don't know if that was 5 or 6 or 7 or whatever, but those were like my 5, I think, top of mind things that I can think of what I want fund of funds managers to. And by the way, I'll say one more thing, Tim. I know you got a question, and I should have said this at the beginning. The 5 things every syndicator must know to stay out of jail. I use the word jail, obviously, intentionally, just to make an impact there. The reason I picked that word jail is because I do think a lot of folks are not taking, especially when I wrote the book a couple of years ago, they weren't taking securities laws seriously. They were just like, oh, everybody's doing it. How are they going to find out? All that stuff. The reality is, it's not impossible. It's certainly, you can absolutely go to jail, but most likely your penalty for doing any of these things is really, for being non-compliant, is really rescission, right? So if you raise, like this guy raised $2.8 million, found that he was acting as an unlicensed broker, he's got to return the $2.8 million to his investors, which, by the way, if the deal goes south, you probably don't have it, but you're supposed to return the $2.8 million plus interest to the investors. Then the SEC comes in and will slap you with penalties and probably bar you from raising capital for a certain amount of time. You only go to jail if you're literally defrauding your investors. If you are running a Ponzi scheme, or you're commingling and using funds from one to another, or using it to buy your yacht, then okay, we're talking Bernie Madoff style. Jail is definitely in the cards. But if you're just non-compliant and you just didn't comply and you violated a rule, rescission and being barred from raising again is usually your penalty, which is still pretty big because you probably don't have it. And so you're probably gonna have to file for bankruptcy. Plus your name's gonna be all over the internet about being this like this guy has no chance of raising money, ever again. So anyway, I just wanted to make that point that I probably should have made at the beginning.
Yeah, my question was around the fee. You said not making it as a percentage of the amount that you raise. Does it means regardless what you call that fee is, whether you're gonna call that fee a due diligence fee or an underwriting fee, whatever you call that fee is irrelevant if it's being calculated as a percentage of the amount that you raise. Is that correct?
Correct. The rule is you cannot take transaction-based compensation. It doesn't say transaction-based acquisition fees or transaction-based success fees or transaction-based due diligence fees. It's like most things, the SEC looks straight through whatever you're naming it and like, what exactly are you doing? And if they see that you're getting compensated specifically for tied to raising money, then that just gives them a better argument and say, look, you're taking a 2% acquisition fee based on how much you raise. Clearly in the documents, you said 2% of the raise, which is what a lot of people do. That's the hallmark of broker-dealer activity. So it puts you really behind the eight ball. I don't even know how you get around that if that's what's in your documentation. So just make sure it says 2%. Sometimes we say a property price, whatever you're acquiring it, or maybe it's acquisition cost because you want to add some other things in there to make it bigger, or just put a flat fee in there. Just I'm getting paid $50K to do this transaction because I got to do all this due diligence. I got to do all this work. If it's a project specific, you're getting the loan, you probably have some kind of carve outs. It's a recourse loan, or even if it's non-recourse, there's always a risk that you're on it. So you're absolutely allowed to get compensated for that, but it's not for raising the money. It's for doing all that work, talking to me and getting the PPM stuff together and doing all that work is what you're getting the acquisition fee. It's not for raising the money.
Gotcha. Now, does that only applies to if the operator is paying you versus another scenario is that, let's say you raise that money through your SPV fund, and then you charging your LPs as a fund manager, let's say you charge a 2% fund admin fee because it's being paid on the fund level, not the deal level. Does that get around it?
No, so I'm glad you brought that up because that's really important and critical. And maybe going back, I'll rewrite this and add this as one of the 5 and get rid of one of these. I don't know which one, but you can absolutely, when you're doing these feeder funds or SPV funds, I'll use your terminology, even though I don't like it. We'll use your terminology. You can never, ever get compensated directly from the underlying operator. The underlying fund cannot write you a check. Because then what is it writing a check for? Honestly, that would be my question. It cannot write you a direct check from the underlying operator, the syndication LLC at the bottom, to you as the fund manager. What you do, which is exactly what you mentioned, is because you're negotiating better terms, or if you're not, you're just diluting your investors. But the distribution that you get from the underlying syndication is your revenue. That's your revenue. It's when the underlying syndication makes a distribution to you, that is your revenue. And so if you've negotiated better terms, so instead of getting 70% of the profits, your share of the profit, you get 80, then you've just generated more revenue into your fund. And once the money is in your fund, then you can charge whatever you want to charge it, a 2% asset management fee, a carried interest, although depending on what state you are, that there may be, again, the advisory stuff might be, but you can charge a flat fee. You can fee it to death. It's up to you to whatever your investors can put up with. You can fee it to death once it's in your fund, but never take direct compensation from the underlying. What we're talking about, Tim, here is on the front end. So when you're raising the capital from the investors, that's where you want to be careful about charging an acquisition fee more on the front end fee based on how much money you're raising. From the bottom up, in terms of carried interest or asset management fees or whatever ongoing refinance fees, construction management, all those fees that you want to charge your fund, As long as you're charging your fund and you've disclosed that to your investors, you can do whatever you want. You just can't you can't take a direct compensation from the underlying syndicator.
Okay. What if you, yeah, so let's say instead of taking it directly from the underlying syndicator, that syndicator pays that, for the lack of better term, 2%. Instead of paying it to you, they pay that 2% to your fund, and then you're charging your fund the 2% fund admin fee. Is that okay? Even though it might be the exact same 2%, but the way it flows through
that
to
may
the
be what
fund?
we call it. Yeah, there's a terminology in the securities world called a disguised commission. And so that starts to look very much like a disguised commission. So if it's the exact amount of money that's coming in through this thing and it all works its way up the system and then ends up in your pocket, that to me looks like a disguised commission. You want to charge traditional fees. So it's very common in the securities world, in the private equity world, like I said, to negotiate better terms, which
Right.
can be typically the better terms are a discount on the carried interest. So the sponsor takes, like I said, instead of taking 30%, they take 20%, they take 10%. That generates more revenue. Or maybe on the acquisition side, maybe they took an acquisition fee, which is they can. Maybe they take a 2% acquisition fee on the front end, but I negotiate, they only take a 1% acquisition fee for them. And so I get to, you get that benefit. But you don't want to match it the exact same. Like I've seen some deals where it's, oh, we're going to give you an additional $102,000 to your fund, and then you just happen to take a fee for $102,000. Like that, why would you do that? Like, try and even charge it differently. If the underlying fee is paying you 80-20, maybe you take a 70-30 or 75-25 or 90-10, or just make it a little bit different, because you do run the risk of this disguised commission argument.
I understand. All right, Jonathan, go ahead and unmute yourself. Yeah, we can hear you. It might not be very clear, but we can try. Yes, that's much better. Yep.
Okay, cool. Sorry about that. It was the headphones. What's going on, Mauricio?
How you doing?
How you doing, Tim?
Good.
What I just really wanted to know something more of a broad kind of question, and I've always wanted to know this, which was, okay, so someone's going to go get into being into a fund of funds. What incentive, what triggers someone to decide to do that? Like the opportunity cost. I'm going to make a fund of funds, or I'm going to participate in a fund of funds instead of whatever, an SP, whatever you don't want to call it. And just like, what is the driving thing that gets someone to want to do that? Is it the fact that they discover they have access to certain things, or can you talk about that a little bit?
They don't want to operate. That's why would you want to some people like to operate, but the headache of actually buying a multifamily and running it and asset managing it and doing all that work, why not just raise the capital, help some of your investors make a return, help them identify properties that they wouldn't otherwise. They may not even know that real estate's really accessible to them. They might be in the stock market. And so you're educating them. Hey, look, here's a great tax play. You invest in my fund. I invest in another fund. We get all the tax depreciation up there. And yeah, it's going to cost you just like a mutual. When you go to a mutual fund, right, the fund manager is going to charge you all these fees because it does all this work. So that's what they want to do. They have access to capital, and they just don't want to. Hopefully they have the expertise. That's one of the concerns I have right now, is some of these don't have expertise yet. They're investing in multifamily without really knowing how to underwrite or how to find them and what they should be looking for. But assuming they do, like, why would you want to, if you can, why would you want to do all that work on finding the markets, finding the properties, doing all this work? Yes, the returns are probably higher if you do it, but on this other one, it's easier. I just do all the work up front. Right? I find the right operators. I do my due diligence on them. I vet them. I vet the properties. I go travel, like I was talking earlier. But then once you make that investment, there's nothing else for you to do. You just collect the distribution and get your reports from the underlying operator. You then turn around and give a report to your investors, and then pass on whatever concerns they may have to the operator. But it's a much simpler lifestyle. And of course, I think the returns potentially are lower depending on how you're negotiating, but some people just don't want to operate. And so if I have access to capital and can help other people.
Right, Mauricio? You could just be an LP in a syndication. That's good enough. What's driving people to fund of funds? Is it their familiarity with?
Yeah, so that's a different question. Yeah, that's a different question, because this is like, why would a fund manager do it? Why would an LP do it? On the SPVs, traditionally, it's been because they can't afford to get in directly. I want to invest in Ray Dalio's fund, Bridgewater. It's a $100 million fund, or actually it's an $800 billion fund. The minimum investment is $5 million. I don't have $5 million, buddy. But Tim has a thing where I can put in 100 grand into Tim's deal. Tim aggregates until he gets to the 5 million and then makes an investment into Bridgewater. Now I finally have access to that investment, which I otherwise wouldn't do. That's the main purpose of a feeder fund, is to give access to folks that I otherwise wouldn't have access to.
That's what I was trying to figure out. Thank you.
Awesome. All right. Yes.
Okay, great. What's up, Mauricio? Oh, cool. I'm doing great, man. So just a question on the same topic, right? When it comes to putting together like a fund of funds, one of the things that I've been thinking about is like, why don't fund of funds managers just get a securities license? It's like a 2-month thing. Like it doesn't take that long. So I'm just wondering like what the reasoning behind not just biting the bullet and like getting a securities license so that you can go ahead and do everything like 100% by the books. Am I missing something?
Most of the time, first of all, most of the time you don't need one, right? If you're in Texas and you're cool with accepting accrediteds only, then you don't need to. Yes, if I'm in Texas and I want to take non-accredited, but I don't even know if you can take non-accredited even if you have a license. So it's only in those states where like Hawaii, I don't know if he's here, but I got a client of mine that's in Hawaii. And so the only way he can do a fund of funds is to become licensed. Or Washington's another state where you don't have, there's an exception, but you have to basically limit your clients to qualified clients, or basically almost institutional clients, which doesn't make sense. So I would have to go get a license there. But so yes, that's one remedy if you don't fit into the exemption, but most people do fit into the exemption. So it's just a question of wanting to go through that compliance nonsense and just making sure you know what the exemption is. And like another one that's a good example is Michigan, because we have a client who's doing one in Michigan. It's like Michigan requires you, I think, to have audited financials or something in order to fit into the exemption. But again, I don't know if you become a licensed in Michigan, if you somehow get around that. Having a license is not something the regulatory crap you've got to deal with, right? The audits, the compliance, there's a cost. It's no fun. Yes, maybe getting the license, I don't think is that difficult. You just take the exam. You've got to find an investment advisor that's willing to take you under the wing, or actually you can set up your own investment advisory firm. But then once you're there, then you're under the guise of whatever state. Imagine I'm in California. Now I'm under the thumb of the California Advisory Committee. So I got to follow all their stuff. Yeah.
So, no, okay. That makes sense. I guess like, so it's not that fund of funds is illegal. It's that if you're taking an equity stake, my understanding is like, if you're taking an equity stake in the GP for raising capital, that's where.
Yeah, this is different. So that's a co-GP model. There's nothing illegal. Just want to make sure there's nothing wrong with doing a fund of funds. There's nothing wrong. It just means you've got more regulatory crap to think about, and you've got to do work. You can't just raise money, not do any work, and give it to somebody else. There's actually work you've got to do to justify the fees and add value to your thing. But if you're doing it properly, like for example, most people don't get on a plane and go fly to the property and do the due diligence on the property. They just take whatever information they got, they look at it, and then they pass it along to the investors. Like they don't actually do independent due diligence. That's where I think you start getting into some issues.
I see. So as long as there's evidence that you are acting as, I don't even know, do you need to be a fiduciary? Is that like
you're always a fiduciary? Like, once you're a fund manager or syndicate, you always have fiduciary responsibility. So you're absolutely a fiduciary either way. It's just that at the end of the day, I think the main issue, and Tim, I apologize, I got to run here, but the main issue is that the compliance means it costs more, right? So it costs more, it takes longer, it's more complicated, it's more of a pain. And if you're just trying to raise a small amount of money, the economics of it may not make sense. But if you're raising $1 million, $2 million fund and you spend the money to do it properly and you follow the advice, like I said, go fly down to the property, there's not an issue at all.
Okay, makes sense. Thanks, Mauricio. Yeah,
of course.
All right, Mauricio, I know you have to go. So where should everybody go to find you, learn from you, connect with you?
If you want the book, stayoutofjail.com. If you want to join me for Q&A or topics every Tuesday, realestatesyndicatedlive.com. Realestatesyndicatedlive.com. That's where you'll actually get the replay that I just did with Tim. If you're part of that list, you get invited to the shows, and then I will send you the replays as well.
All right, stayoutofjail.com and realestatesyndicatedlive.com.
Thanks, everyone. Appreciate you guys. Good spending the night last.
Group picture real quick before you go. Everyone turn on your camera. Real quick. Come on, group picture with Mauricio real quick. Everyone turn on your camera. I'll pose. Reflex, Mauricio. Yes, there you go. All right, ready? 3, 2, 1. Yay. All right, thank you so much.